Hello all. Today we will be discussing foreign exchange arbitrage. So what is foreign exchange arbitrage? First of all, let us understand what is arbitrage. So arbitrage is the process of a simultaneous sale and purchase of currencies in two or more foreign exchange markets with an objective to make profits by capitalizing on the exchange rate differentials in various markets. Now, the arbitrage opportunities exist due to the inefficiencies of the market. While dealing in the arbitrage trade, an individual can make profits only out of price differences of similar or identical financial instruments traded on different exchange markets. Therefore, the price differential is captured as a trade's net payoff. Now, this payoff should be large enough to cover the expenses that are incurred in executing the trade. So, these are also known as the transaction costs. We can take an example here. Let us say that the stock of company ABC is being traded at rupees 2000 on Bombay Stock Exchange, while the same stock is being traded on National Stock Exchange at rupees 2500. Now, a trader can earn a profit of rupees 500 by buying the stock on Bombay Stock Exchange and immediately selling the same share on National Stock Exchange. So he will buy from BSE at rupees 2000 and can sell it at National Stock Exchange at 2500, whereby earning a total profit of 500. And let us say if his transaction costs are rupees 100, then 400 becomes his net profit. So that is a way where you buy from the low cost market and sell in the high price market, and the differential minus the transaction cost becomes your profit. Now, this arbitrage opportunity, which can be availed until BSE or the Bombay Stock Exchange runs out of the shares of company ABC, or till the time Bombay Stock Exchange and the National Stock Exchange adjusts the price differences so as to wipe out the arbitraging opportunity. Now, basically, the importance of arbitrage lies in its ability to correspond foreign exchange rates in all the major foreign exchange markets. So, the arbitraging involves the transfer of foreign exchange from the market with a lower exchange rate to the market with the higher exchange rate. Therefore, arbitraging equates the demand for foreign exchange with its supply, hence acting as a stabilizing factor in the exchange markets. Now, the arbitrage opportunities can be availed only where the foreign exchange is free from the controls, and if any, controls actually should be of very limited significance. If the sale and purchase of foreign exchange are under severe control and regulation, then the arbitrage is not possible. So practically, the arbitrage opportunity exists for a very brief period, since in the mature markets, the most of the trading has been taken by the algorithm based trading. Now, what is algorithm based trading? It is a trading system that actually relies heavily on mathematical formulas and computer programs to determine the trading strategies. Hence, it is a very sophisticated system. Algorithm based system is a very sophisticated system which actually reduces the time lag between the transactions. So these algorithm based tradings are quick to spot and they are very easy for trader to keep track, and it actually ensures the uniformity of prices in the market, and hence it poses a challenge for the arbitrage process. But what is foreign exchange arbitrage? It is the strategy of exploiting price disparity in the foreign exchange markets. So it may be affected in various ways, but it is carried out. The arbitrage seeks to buy currency prices and sell currency prices that are currently divergent but extremely likely to rapidly converge. So the expectation is that as prices move back towards a mean, the arbitrage becomes more profitable and can be closed, and in fact sometimes even in milliseconds it can be closed. So foreign exchange arbitrage is a trading strategy that seeks to exploit price discrepancies between high price markets and low price markets. So market participants engaged in arbitrage collectively help the market become more efficient. All types of arbitrage rely on unusual circumstances being temporarily extant in the market. Now, how foreign exchange arbitrage works? So, because the foreign exchange markets are decentralized, even in this era of automated algorithmic trading, there can exist movements where a currency traded in one place is somehow being quoted differently from the same currency in another trading location. So, an arbitrator is able to spot that discrepancy and can buy the lower of the two prices and sell the higher of the two prices, and likely to lock in a profit on this divergence. So in the lower price market, the prices will start getting higher, and in high price market the prices will start becoming lower, and hence they will diverge, and which would result in lesser profits for the arbitrator. Now, for example, let us suppose that euro and Japanese yen forex pair has been quoted at 122.5 by a bank in London, but it was quoted at 122.540 by a bank in Tokyo. So we can see that there is a 0.40 difference. Now, a trader with access to both quotes would be able to buy the London price and sell the Tokyo price. So, when the prices had later converged, let us say the prices became 122.550. So, the trader would actually close both trades. Now, how will he close both trades and what profit will he get? So, because he has locked the Tokyo one at 122, London one at 122.500 and Tokyo one at 122.540. So, the Tokyo would lose 1 pip, like 10 points, 1 pip. So 540 to 550, it has lost 1 pip, whereas the London position has gained 5 pips, right? 50, it is an increase of 50. So the trader will gain how much? 40 points, that is 4 pips, but it would be less the transaction cost, because he would be incurring certain transaction costs that would be deducted from his profit of 4 pips or 4 points, and he will get the resultant amount as his profit. Now, such an example may appear to imply that a profit so small would hardly be worth the effort. Yes, so we can say that 4 points, that is it, that is the profit the arbitrator is having. But many arbitrage opportunities in the foreign exchange market are actually this minute, or they may be even smaller than this. So because of such discrepancies could be discoverable across many markets many times a day. Imagine the foreign exchange market is working for 24 hours, and if such opportunities are coming every now and then, so it is worthwhile for specialized firms spending the time and money to build the necessary systems to capture these inefficiencies only and to have profits through them. Now, this is a big part of the reason that the foreign exchange markets are so heavily computerized and automated these days. So, automated algorithmic trading, I told you, they rely so much on the computer systems and digitized they are, that they have shortened the time frame for foreign exchange arbitrage trades. So the price discrepancies that could last several seconds or even minutes now may remain for only a sub-second time frame before reaching the equilibrium. Now what will happen? It would make the arbitrator's position much more challenging, because now it's the millisecond or a sub-second in which the transaction difference would just wipe off or wipe away. So in this way, arbitrage strategies have made the foreign exchange market more efficient than ever. So the moment there would be a discrepancy, any arbitrator would step in and it would diverge the prices, and hence the foreign exchange markets would reach their efficiency, right? So however volatile, markets and price quote errors or staleness can and do still provide arbitrage opportunities. So because of this automated algorithmic trading, the arbitrage opportunities are very less. But because the markets are so volatile, they're changing every millisecond, as well as there can be certain price code errors that can happen. So these things may still provide the arbitrage opportunities. Now, what are the other foreign exchange arbitrage? So the first one is the currency arbitrage, which we would be just discussing at length in some time. So currency arbitrage, it involves the exploitation of the differences in quotes rather than movements in the exchange rates of the currencies in the currency pair. So a cross-currency transaction is the one that consists of a pair of currencies traded in foreign exchange that does not include the US dollar. So ordinary cross-currency rates involve the Japanese yen. Arbitrage seeks to exploit pricing between the currency pairs or the cross rates of different currency pairs. So, for example, we have done the cross currency rates like Thai baht and Indian rupee. That's a cross currency rate between them. So, a Japanese yen and Indian rupee cross currency rate would apply, or let us say Indian rupee, that is INR, and Swiss francs CHF. So in them also there would be a cross currency exchange rate that would apply, and hence the arbitrage would be cross currency arbitrage. Now another one is covered interest rate arbitrage, the practice of using favorable interest rate differentials to invest in a higher yielding currency and hedging the exchange risk through a forward currency contract. Also, there is another type of arbitrage, and that is uncovered interest rate arbitrage. It involves changing a domestic currency which carries a lower interest rate to a foreign currency that offers a higher rate of interest on the deposits. So spot future arbitrage is also there. That also comes under currency arbitrage. But what does it mean? It involves taking positions in the same currency in the spot and futures market. For example, a trader would buy currency on the spot market and sell the same currency in the futures market if there is a beneficial pricing discrepancy. Some circumstances can hinder or prevent arbitrage. What are those foreign exchange arbitrage challenges? A discount or premium may result from currency market liquidity differences, which is not a price anomaly or arbitrage opportunity, making it more challenging to execute trades to close a position. Arbitrage demands rapid execution, so a slow trading platform or trade entry delays can limit opportunity. Time sensitivity and complex trading calculations require real-time management solutions to control operations and performance. Now, this need has resulted in the use of automated trading software to scan the markets for price differences to execute foreign exchange arbitrage. Foreign exchange arbitrage often requires lending or borrowing at near to risk-free rates, which generally are available only at large financial institutions. The cost of funds may limit traders at smaller banks or brokerages. Spreads, as well as trading and margin cost overhead, are additional risk factors. Now, what is currency arbitrage? A currency arbitrage is a foreign exchange strategy in which a currency trader takes advantage of different spreads offered by brokers for a particular currency pair by making trades. Different spreads for a currency pair imply disparities between the bid and ask prices. Currency arbitrage involves buying and selling currency pairs from different brokers to take advantage of the mispriced rates. Currency arbitrage is the exploitation of differences in quotes offered by the brokers. Currency arbitrage can be practiced using different strategies such as two currency arbitrage and three currency arbitrages. Now, if we want to understand the currency arbitrage, we have to understand that it involves the exploitation of the differences in quotes rather than movements in the exchange rates of the currencies in the currency pair. So, foreign exchange traders typically practice two currency arbitrage, in which the differences between the spreads of two currencies are exploited. Traders can also practice three currency arbitrage, that is also known as the triangular arbitrage, which is more complex strategy. Due to the use of computers and high-speed trading systems, large traders often catch differences in currency pair codes and close the gap quickly. The most important risk that foreign exchange traders must deal with while arbitraging currencies is execution risk. So, this risk refers to the possibility that the desired currency quote may be lost due to the fast moving nature of foreign exchange markets. There can be few examples of currency arbitrage. For example, two different banks, let us say Bank A and Bank B, offer quotes for US or European currency pair. Bank A sets the rate at 3/2 per euro and Bank B sets rate at 4:3 per euro. In currency arbitrage, the trader would take 1 euro, convert that into dollars with Bank A, and then back into euros with Bank B. The result is that the trader who started with 1 euro now has 9/8 euros. So the trader has made a 1/8 euro profit if trading fee are not taken into account. So by definition, currency arbitrage requires the buying and selling of the two or more currencies to happen instantaneously, because an arbitrage is supposed to be risk-free. With the advent of online portals and algorithmic trading, arbitrage has become much less common. With price discovery high, the ability to benefit from arbitrage falls. There are different types of currency arbitrage which we would be discussing. The first one is the locational arbitrage. It is the most common type of foreign exchange arbitrage and involves two currencies. We have already given an example of this type of arbitrage above. Let us take another example, but this time with bid and ask spread. So suppose Bank A has US dollar 1.52 or 1.57 for GBP, while Bank B quotes US dollar 1.58 is to 1.60 for the GBP. Now in this case, the trader would buy 1 GBP from Bank A at 1.57 and sell it to Bank B at $1.58. Now this way the trader makes a profit of $0.01 per GBP. Now let's take the same example but with different bid and ask spread. So let us say that Bank A quotes 1.52 oblique 1.57 US dollars for GBP, but Bank B quotes 1.56 to 1.60 US dollars to GBP. Now in this case, the arbitrage opportunity does not exist. Why? Because the bank would buy at 1.57 and cannot sell at lesser price. So if a trader buys GBP at Bank A for $1.57 and sells to Bank B at $1.56, the trader will incur a loss of $0.01 per GBP. Hence, the arbitrage will not take place. Then triangular arbitrage. So as the name suggests, this arbitrage involves the use of three currencies. Such type of arbitrage exists if the cross exchange rate of two currencies does not match with the currency exchange rate. So in triangular arbitrage, we calculate the cross exchange rate of two currencies and then compare it with the actual rate in the exchange. So we can say the triangular arbitrage benefits from the irregularities in the cross rates. For example, we can use US dollar to euro and US dollar to GBP to calculate the cross exchange rate of GBP to US dollar. Let us take an example to understand this arbitrage. Suppose at a given time, the following are the exchange rates. Let us say 1.5 US dollar to euro and 1.7 US dollar to GBP, and then 1.5 euro to GBP is the rate. Now a trader needs to calculate the cross exchange rate for euro to GBP using USD to euro and USD to GBP. So in our case, the euro to GBP will be 1.7 to 1.4, that is 1.21. However, the actual euro to GBP quote is 1.5, so we can say that arbitrage opportunity exists. But how? Now in this case, we first convert USD to 1.7 into 1 GBP, then we convert the GBP into 1.5 euro. Now we turn this 1.5 euro back into US dollar to get 2.1 US dollars, which made a profit of $0.5 in this trade, and hence the arbitrage would exist. Next of the type is covered interest arbitrage. So under this, a trader uses interest rate differentials to invest in a currency, and then the trader hedges the risk with the help of a futures or a forward contract. So the uncovered interest rate arbitrage also exists, and it is the same as covered one, but it does not have a futures or forward contract. Now in this type of arbitrage opportunity, the conversion happens between a local currency with a lower interest rate to other currencies with a higher interest rate. What are the risks in currency arbitrage? So arbitrage is supposed to be risk-free, but we can't say the same about the foreign exchange arbitrage. Foreign exchange traders face execution risk. It is the risk that the arbitrage opportunity may get lost because of the fast-moving nature of the foreign exchange markets. Because of the use of computer systems and algorithms, the price gaps or irregularities get quickly filled, resulting in fewer arbitrage opportunities. Now, the key to currency arbitrage is the timing, because the trader needs to buy and then sell the currency instantly. Since the currency market is very liquid, there exist only a few opportunities for this arbitrage. Moreover, these opportunities last just for a few seconds, or in fact even split of a second, as the prices rapidly converge. So the computer systems and algorithms actually make the arbitrage opportunities very challenging. The foreign exchange market is heavily computerized and automated to take benefit of such split-second irregularities. Now, despite this, there exists arbitrage opportunities due to the volatile nature of markets and price quote errors. But the price discrepancies now last only for a sub-second in comparison to several seconds or even minutes earlier. These are the references. Thank you for listening.